What's going on, everybody? Welcome back to another Multifamily Minutes episode here on the Multifamily Hour podcast. In this episode, I'm going to spend some time talking about the importance of focusing on the margins from an operation standpoint within multifamily investing. And I think that this is top of mind because it's something that every operator who's operating multifamily property should be focusing on. But I think it only continues to be more and more of a focal point for operators who are trying to squeeze the most out of deals that they've bought over the last few years, or worse yet, 5, 6 years ago when the market was really humming. And I also think that this is topical because I think I think I've just looked at a lot of deals recently, like C-class deals that are marketed by brokers, where the pricing just one obviously didn't make sense, right? I mean that's going to be the vast majority of deals you look at that are sent out by brokers, but where I'm getting a little tired of seeing the same repairs and maintenance numbers and then the same operating expense numbers from insurance and everything else, but even more specifically above and beyond that, seeing the same vacancy assumptions and even more specifically like bad debt and delinquency assumptions at the deal level. And these are numbers that vary wildly between A, B, C, and D class investing. We primarily buy C class deals, so that's kind of my frame of reference, and then maybe 25% of our portfolio is B class. But we do a lot of B, we do a lot of C, primarily C. And I think that one, most investors overestimate the percentage of your gross potential rent that you're going to collect, and also underestimate your vacancy rate, right? I think those are two things that cut both ways. And at the end of the day, these are really important assumptions to get right because they fall under the revenue category of what you're underwriting. If you collect more, you're obviously your revenue is going to be higher. And if you reduce your physical vacancy and increase your physical occupancy, your revenue is going to be higher. Like obviously we know that. But the thing is I think many investors continually forget that it's like similar to leverage in a way, like using leverage, right? If you use a ton of leverage on a deal or an investment, small incremental gains in the value of that investment have an outsized return metric to the cash you invested because you use leverage. And then the same thing the other way. Smaller reductions have an outsized reduction on the capital you invested because of the leverage that you've used. It's the same exact concept with increases in revenue when you're investing in multifamily and operating multifamily real estate. At the end of the day, the vast majority of your expenses are fixed in this business, right? Your insurance, your taxes, your contract services, such as your landscaping, trash, etc. The vast majority of these are fixed, right? And there are a couple of expenses that are technically variable. Your water and sewer, if you're, paying for it as the operator or the owner, that's going to be a little higher as your vacancy rate goes down and your occupancy rate goes up because more people are just using the sinks and the faucets and whatever. Common area electric is maybe going to go up if it's tied into some type of tenant usage like coin-op laundry or something like that. But that's that's peanuts compared to the big numbers on the expense side of the P&L, which is your insurance, your taxes, and your contract services. So, all that being said, small incremental increases or reductions in your revenue have an outsized impact on your NOI. And then when you account for the debt service payments, an outsized impact on your net free cash flow. So that's what we're going to talk about here, right? And the big theme is if you can reduce your bad debt or your delinquency rate from call it 3% to 2%, doesn't really seem like that big of a deal. Like when we just say it out loud, it's 1% difference. But I want to talk about the magnified 4 to 5+ X output that has on your net free cash flow. And it's the same thing with reducing your vacancy rate, right? If you can reduce your vacancy rate from 5 to 4% or 5 to 3, or you do, something along the lines of reducing your vacancy rate from 5 to 4 and your bad debt from 3 to 2, that's going to have an insanely outsized impact on what happens from a net free cash flow standpoint. So let's talk about some math here because, it's always fun to illustrate this with data. If you're listening to this in the car or at the gym or whatever, just hang in there with me here. I'm going to try to simplify this so that I don't, one, bore you, or two, lose you. Both are kind of the same thing, but I want to just share general outline of a deal and underlying assumptions because I think this is going to be extremely similar to the deals and the NOI percentage and the debt and all of that that many of the listeners are using, right? So I'm basically going to create a deal here as an example that I believe many of the folks listening to this have bought in some capacity. Let's say you own a 10 unit building, 10 one bedroom units, each is renting at $1,500 a month, or at least that's the market rent for each. And you've got $180,000 of gross potential rent, right? That's 15,000 times 12. That's what you can make if everything goes perfectly in a given year. Let's say you are operating at a kind of the, roughly market standard vacancy rate and delinquency rate of a 5% vacancy rate and 3% delinquency, meaning you're 95% occupied throughout the year and you can't collect 3% of the rent that you should have collected based on your occupancy rate. What that means is you collect 165,600, round numbers, 165K out of your 180K gross potential rent every year. Let's assume you've got 30 some odd percent expense ratio here. That might be low, but again, we're just trying to use example numbers. You back out 65,600 in expenses and you're at $100,000 of NOI. That's what I'm trying to get to, is just a clean number of $100,000 in NOI. And $100,000 in NOI, if this property trades at a 6.7 cap, means the building's worth 1.5 million bucks roughly. All that being said, let's assume that you've got interest only debt at 75% loan to value and your interest rate is 6%, right? So you've got 67,500 in interest cost every year, right? That's what's going out the door in interest to service your debt. And that means your net free cash flow is $32,500 a year. Back up, back up, back up. Let's just, tie this all back together. 10 unit building, each unit can rent for market rent $1,500 a month. You're running at a 5% vacancy, 3% delinquency. With some expenses, you're netting $100,000 in NOI, 67.5, at 75 LTV and 6% interest rate, nets you 32,500, right? Now let's talk about what happens if we recover a single percentage point of revenue that we should have collected. So two ways to do this, right? We push occupancy from 95 to 96% over a given year, or we cut delinquency from 3 to 2%, right? Those are two ways of achieving the same outcome. Either way, we're picking up $1,800 in additional revenue on an annual basis. That's what happens there. So what happens after that? Now we start to think about, what does that $1,800 a month in incremental revenue do for us? Again, that number doesn't sound like a lot in the grand scheme, but $1,800 in additional revenue when compared to the net free cash flow of $32,500, that's what starts to tell the story here. That's what starts to really be meaningful. Again, we're assuming the expenses stay the same, right? Maybe we have a few $100s more a year in water bills or something like that, but we're just going to assume that that income drops straight to the bottom line, which in all reality and practicality, it basically does. So what does that do for us? $1,800 against $32,000 in, $32,500 in net free cash flow. A 1% increase in revenue has just increased our net free cash flow by 5.5%. So that's the whole episode that I'm recording here, right? A 1% increase in revenue increases our net free cash flow by 5.5%. That is a 5x outcome on our net free cash flow. That's why this is really important, right? And then we go the other way. Let's say we lose a point, right? Let's say we dip from 95% occupied to 94. That reduces our net free cash flow by over 5%. So it's a 5x relationship. That's what I'm trying to get at. You've got a deal that's trading at a 6.7 cap, right? I'll explain all of this in a different way. You've got a deal that trades at a 6.7 cap, right? In this situation, that's $100,000 in NOI in this example. But at a let's say you've got a deal that's a 6.7 cap deal with 75% LTV, 6% interest only debt, with 5% in underwritten or operated vacancy and 3% in operated delinquency. If you increase revenue by a point, it has a 5.5x impact on your net free cash flow, 5.5% increase. That's what we're talking about here. So let's go to the logical extreme. Let's say we increase revenue by 3%, which in all practicality here, that's we increase our occupancy rate by 2%, we go to 97% occupied, and maybe we reduce our bad debt or our delinquency by 1%, we go from 3 to 2. What does that do for us? So that increases our revenue by whatever that is, 36, 50, $400. Now we're up to a over 15% plus increase to our net free cash flow, right? Just a 3% difference now has created 30, or excuse me, 15 plus percent, 16 plus percent in additional cash flow. When you actually look at that over the course of multiple years, that kind of makes or breaks your deal, really, at the end of the day here. And I think that's what's really important for all of us to understand here is that this is one of the most, if not the most important things that you can focus on when you're operating multifamily. And this is especially critical over a larger portfolio or over a larger building because the numbers become a little bit more normalized and it's easier to actually assess them. In a 6 unit building, if you have 1 unit turnover and it goes vacant for 2 months and you've got one tenant who doesn't pay for 2 months, like your numbers are going to be really shot. But then you might have 2 years after that where it's pretty consistent and it's much choppier, right? It's like kind of hard to really assess these numbers in like in a much more precise way. But over a 50, 100 unit portfolio or over a 50, 100 unit building, you should really try to make little incremental improvements with both of these figures because it drastically changes the outlook of a deal over a long period of time. This is something that we're really focusing on in our business right now is how can we use more tech? How can we improve our systems and processes to increase our collections rate, right? To decrease our bad debt rate. I don't think many operators think about that. Like, obviously, you want to collect as much rent you can, and usually it's a tenant screening challenge, right? You want to screen your tenants very diligently and place the best ones to reduce the chances that you have evictions or just, that you have issues with collections. That's step one, and that's 90% of the battle. But the other 10% to get that last point is creating some type of systems around this, right? And we've started using different technology platforms that integrate with our PM software that will actually take on the debt risk for a particular tenant and help them create payment plans so you can collect some discounted rate up front or discounted amount up front on a tenant's past due balance. And then that counterparty then goes and takes the risk of actually collecting that from that tenant and creating some type of payment plan. So you're basically outsourcing the payment plan process. And there's also, just a whole bunch of things you can do from a process standpoint. Increasing the follow-up rates when somebody's late, spending a lot of time trying to understand the reasoning, being much more diligent, frankly speaking, with your demand for rent process, right? Getting those out faster and getting them out and really communicating that we're prioritizing collections and that we will have to unfortunately see this situation through. So there's a lot of different things that you can do when you start focusing on it and you actually start creating processes around it and maybe adopting new tools that can help with it from a tech standpoint. The last little button up thing I'll put on this, because I think a lot of people don't even really understand what their like delinquency should be or what it is in a market or what, any of that stuff, which if you don't own a lot of real estate and you don't have your own portfolio to look at, it gets harder, right? We have a large property management company where we manage a whole bunch of units in a small area. Like we have a lot of comfort around understanding what our vacancy rate is and what it should be across different classes. So, for example, in our business, what we typically see is that we have a roughly 90% collection rate between the first and the fifth of every month. And this is assuming C-class real estate, right? From the first to the fifth, we've collected 90% of the rent that we should have collected that month based on our physical occupancy. Between the 5th and the 12th, this is when late fees start hitting. This is when demands start going out. We typically collect another 5%. Right? We go from around 90 to 95% collections between the 5th and the 12th of each month. And then from the 12th of the month to the end of that month, so from the 12th to the 30th, we usually get that last 2 or 3%, and we usually get to right around 98% collections. We're very happy with that number. That number used to be 97%, right? I mean, it used to be lower. And that number fluctuates depending on if we're onboarding a new, we just took over a portfolio of buildings that we bought, and we took over management, and a whole bunch of those tenants weren't screened right by the previous owner, and our collections are going to take a hit portfolio wide because of deals that we're working through the stabilization process on. But for stabilized buildings, let's just call it 12 months of ownership, or longer, and we've like had a chance to really work through and get our hands dirty within the building itself, we're probably going to be right around at 98% normalized collections. So for us, our focus is like, can we get from 98 to 98 and a half, 98.75, 99? Like, that's a really big ask. It's going to be really hard to do that. So, but we're still trying, right? We're still trying to figure out how to never dip below 98 because, again, this cuts the other way. If you go from 98 to 97, you're losing, assuming kind of standard debt, standard cap rates, the examples I used, you're losing 5, 6% in cash flow. So that's really what we're focused on our end. And right now for us, the easiest lever to pull, the lever that you have far more control over as the operator is your vacancy rate. One of my favorite quotes is, and I've really been trying to, really be mindful of this recently, is rents are a market decision and vacancy is an operator decision. So I'll say that again. Rents are a market decision, right? The market decides what you're able to charge in rent. You don't get to decide that. That's not up to you. You can renovate your building and you can make it really nice and et cetera, but you can't just ask for way more than what the market's willing to give you. That's not how it works. That's why it's a market decision. The market dictates the rent that you can charge. That said, vacancy is an operator decision. It's up to you whether or not you cut your rent fast enough to get ahead of a falling environment where rents are declining and to get a tenant in the door and get a good application. That's up to you. If you're going to set your rent above market and you're never going to change it, well, that's your decision. You're accepting that vacancy. That vacancy is now your decision as the operator. So, what we're being really mindful of, knowing that we're not in an environment where rents are really growing right now, is this sat for a couple of weeks. We might have been off on the rent. We might not have had enough data to make an educated decision. We're going to rapidly cut significantly to get underneath where the market is and get this leased up so that we increase our physical occupancy rate. And then on renewals, we're only ever going to increase rent right now in renewals on units that are very clearly below where the market is. We're just not going to increase rent on units if we don't know if we're going to be able to get the existing rent. If this tenant leaves, we have to spend turn costs and release. We're just never going to do that right now. That makes no sense. So for us, that is what we feel like is much more in our control, is how do we take our physical occupancy from 94, 95 right now to 96, 97. Like, we have a lot more control over that part of the process. Anyways, I hope this episode was valuable. I know this was dense, right? Anytime I start getting into mathematical examples, I know it can get dense here on the podcast, but I always think it's really helpful because it's one thing to say, yeah, you got to collect more in rent, but it's another to illustrate the actual importance of it, where if you can increase revenue by 3% on a deal that's got 75% LTV debt, that has a 15% plus effect, 16% plus effect on your net free cash flow, which I think is really the big thesis statement here in this Multifamily Minutes episode. If you learned something in this episode, please leave the podcast a rating and review. Send this to a business partner, send this to a colleague, send this to somebody you work with if you think they're going to learn something here. Send this to your third-party property manager, right? Tell them why it's so important that we got to chase those last couple of percentage points in revenue. But again, I appreciate you all for listening, and I'll catch you guys on the next episode.